is honestly a great question. When you have an IUL and you have a cash value built up and you want to borrow from it because you're allowed to through the policy loan provision, what are the negative effects? Number one, and the most obvious, is that if you have $50,000 in your cash value and you borrow out $20,000, you no longer have $50,000 to borrow from. You have $30,000 to borrow from. You can't borrow the money twice. You can only borrow it once. So you deplete your overall borrowing capabilities. That's number one. Another con would be that the money also comes out of your death benefit. You were to pass away and you haven't repaid the loan back to your policy, then your beneficiary, whoever is going to receive the lump sum of the death benefit, is going to get $20,000 less than they would have. If the overall death benefit was $200,000, your beneficiary is only going to get $180,000. Not a huge deal because you used the money and so it didn't go to your beneficiary, but you used the money. Another con would be that if you don't pay the loan back and the loan was significant enough to deplete your cash value. So if you had $50,000 in your cash value and you pulled out, say, $48,000, and then your policy wasn't earning any interest, and the interest on the loan also ate into that remaining $2,000, your policy would lapse. Your policy would cancel. You wouldn't have a policy anymore. You could potentially be taxed on the money that you pulled out from the policy. If you pulled out the money and your policy was in danger of lapsing, you could just pay back a portion of the loan, right? That would keep your policy in force. No big deal. As far as the other two, the point of purchasing an IUL for most people is to build the cash value, and they're not so much concerned about the death benefit. So access to the loan is more valuable than losing purchasing power, and the access to the loan, being able to use the money, is more important than having the money hanging over your head in a death benefit. As for the pros of pulling out a loan from your policy are that loans are debt. Debt is tax-free. You don't pay taxes on debt. So when you take out that money, you just received $20,000 that you're not having to claim on taxes. Yes, it was your money, but you're using it again. Another pro would be if you had that $50,000 cash value, the value of your policy is also $50,000. And when you take out the $20,000, yes, you depleted your overall borrowing capabilities, but the value of your policy stayed the same. You continue to earn interest on the entire $50,000 as if it never left. Another pro is that the interest on the loan actually can earn you more interest. Stay with me, because let's say you pulled out $6,000 and it had a 5% interest rate. That's $300 of interest. But that $300 of interest gets to earn interest with your overall account value, meaning that you earn interest on more money than you would have if you hadn't taken the loan. Another pro would be that because you have the death benefit over your head, the death benefit acts as collateral when you do take a loan out of the policy. So when you take the loan, you're good for the money because the insurance company says, hey, if you pass away without repaying it, we're just going to subtract it from your collateral. We're just going to give your beneficiary less money because you use the money. So that one's kind of a pro and a con, right? It depends on your priorities. As I'm talking, I realize that some people would probably say that a con of pulling out a loan from your life insurance policy is that it has interest. I just don't see this as a con because any loan that you get from anywhere is going to have an interest rate on it. Would you rather pay an interest rate to the bank, or would you rather pay an interest rate to you? A loan that you don't technically have to pay back because you have the collateral, and when you pay back the interest on a loan you borrowed from yourself, you're the one who gets the interest back. When you pay the loan back with interest, you don't get the interest back. But when you borrow from your life insurance policy because you're the bank, you get the interest back. It's really, honestly, I said I love this question. It's a really good question because it's hard to say that the negatives outweigh the positives, because I don't think they do. You need to learn more about this, or you're interested in getting your own IUL set up. Power 3 Financial focuses on education. We can literally show you what it looks like to take loans from your policy in an illustration, in a policy projection, show you what it looks like to pay it back, show you what it looks like to not pay it back, show you different interest rates, show you what it looks like to pay the interest back to yourself even. The IUL can be extremely valuable during your lifetime to give you and your family or your business leverage options that don't require credit checks or going to the bank or getting approved for a loan. If you're interested in any of this, check out Power 3 Financial. I'll see you there.